Imagine waking up one morning to headlines flashing across financial news. Inflation cooling, interest rates stabilizing, investor confidence returning. The market that felt uncertain just months ago suddenly feels alive again. A new bull run is forming. And now, the big question hits investors everywhere. Where should you position your money to capture the biggest gains? Should you lean into the powerhouse of the United States market or look north to Canada's resource-rich economy? Today, we're breaking down this battle step by step to understand which stock market strategy could truly win in the next bull cycle. Let's start with the United States. The U.S. stock market is home to some of the most innovative and influential companies in the world. From artificial intelligence to cloud computing, from electric vehicles to biotechnology, American companies dominate high-growth industries. When we talk about explosive bull markets, we often think of companies like Apple Inc., Microsoft, and Nvidia. These aren't just corporations. They are global ecosystems, driving entire sectors forward. During liquidity-driven expansions, when capital flows freely and optimism surges, U.S. growth stocks tend to accelerate rapidly. Investors reward innovation. They reward scalability, and they reward companies that can dominate global markets. But here's the deeper strategy behind the U.S. approach. The American market thrives when interest rates are stable or declining. Lower borrowing costs encourage business expansion, consumer spending, and higher valuations. Growth stocks, particularly in technology, perform best when earnings expectations rise and investors are willing to pay a premium for future potential. In the last major bull run, tech-led momentum created massive wealth for investors who positioned early. If the next bull market is driven by artificial intelligence breakthroughs, automation, and productivity gains, the U.S. strategy could once again lead the charge. However, no strategy comes without risk. U.S. markets often trade at higher valuations compared to global peers. That means expectations are already elevated. If earnings disappoint or regulatory pressure increases, volatility can spike quickly. Growth stocks can rise fast, but they can also correct sharply. So while the upside may be powerful, the ride can be intense. Now, let's shift our focus to Canada. The Canadian market operates differently because its economic foundation is different. While the U.S. is innovation-heavy, Canada is resource-heavy. The Canadian stock market is dominated by financial institutions, energy companies, and materials producers. This creates a very different investment dynamic. Instead of high-growth tech leadership, Canada offers exposure to commodities like oil, natural gas, gold, and industrial metals. In a global expansion fueled by infrastructure spending, manufacturing demand, and energy consumption, Canadian stocks can shine. When commodity prices rise, profits for resource companies often expand dramatically. Additionally, Canadian banks have historically demonstrated stability and consistent dividend payments. That dividend component is critical. Many Canadian stocks offer higher yields compared to their U.S. growth counterparts. In a steady bull market, not necessarily explosive, but consistent, reinvested dividends can compound returns significantly over time. The Canadian strategy, therefore, revolves around stability, income, and cyclical strength. It may not generate the same headlines as a surging AI stock, but it can provide durable performance during commodity supercycles. If inflation remains moderately elevated and the world continues investing in energy security and infrastructure rebuilding, Canada could outperform expectations. Another important factor for U.S. investors to consider is currency exposure. Investing in Canadian stocks introduces exposure to the Canadian dollar. If the U.S. dollar weakens during the next cycle, American investors holding Canadian assets could benefit from favorable exchange rate movements. However, currency fluctuations can also work in the opposite direction, adding another layer of complexity to cross-border investing. So now the big question becomes, what type of bull market are we likely entering? Historically, bull markets tend to fall into two broad categories. The first type is innovation-driven. These cycles reward disruptive technology, scalable platforms, and rapid earnings growth. The second type is commodity and cyclical driven. These reward industrial expansion, resource demand, and financial sector strength. If artificial intelligence continues reshaping industries and productivity gains accelerate across corporate America, the U.S. market could dominate once again. But if global growth fuels strong demand for energy, metals, and banking services, Canada may surprise investors looking only south of the border. Here's where smart portfolio construction comes into play. Instead of viewing this as a competition where only one market wins, many strategic investors consider blending exposure. Allocating capital to U.S. growth stocks captures innovation upside. Adding Canadian dividend and commodity exposure provides inflation protection and income stability. This hybrid strategy can potentially reduce volatility while maintaining strong return potential. History shows that market leadership rotates. The sector or country that outperformed last decade does not automatically lead the next. After periods of heavy tech dominance,
cycles often broaden to include energy, financials, and industrial sectors. Diversification across both markets could position investors to capture gains regardless of which theme takes the lead. For U.S.-based investors specifically, the decision ultimately comes down to risk tolerance and macro outlook. If you believe the next cycle will be driven by technological breakthroughs and expanding valuations, leaning heavier into U.S. growth could make sense. If you expect persistent inflation, rising commodity demand, or global infrastructure expansion, Canadian exposure could add valuable balance. The key takeaway is this: the next bull run will reward preparation, not prediction. It's less about choosing Canada versus the United States and more about understanding the economic forces that will shape the coming cycle. Innovation, inflation, interest rates, and global demand will all play a role in determining leadership. As investor confidence builds and capital re-enters the market, positioning becomes critical. The United States offers scale, innovation, and aggressive growth potential. Canada offers resources, dividends, and cyclical strength. Both markets have powerful advantages under the right conditions. So when the next bull market officially takes off, the real winners won't be those who guess correctly at the last minute. They'll be the investors who analyze the landscape early, diversified strategically, and aligned their portfolios with the economic trends ahead.